Okay, so the very best way to solidify and cement all your learnings from the course and to bring everything together is really to go through some recent trade examples. I know we've gone through several examples through the course, but I just want to go through several more just to really reinforce the key elements of every single trade, because they are very, very common. You're going to be doing the same thing time and time and time again. The only variant really is the currency pairs and the news events that you're going to be trading. So let's go through 5 examples of some recent trades that set up in terms of the rationale as to why we would have taken the trade, because that's the most important thing, because your job is essentially to have reasons why a currency is strong or weak, and then to pair the two opposites together, so you're always trading strong versus weak or weak versus strong, depending on what the base is and what the terms is. So let's go through some examples. So the first example is a dollar CAD buy trade after the US and the Canadian GDP figures on May the 29th, 2015. So let's have a look at those releases, because that's what we'll be focusing our attention on. So on Friday, May the 29th at 1:30, that would have been London time, we had the GDP figures from both Canada and the US. Now, in regards to the outcome, we got a worse than expected Canadian GDP. So that was bad for Canada and bad for the Canadian dollar. This would have created some weakness running through the Canadian dollar. Whilst in regards to the US GDP, it actually came in better than expected. It was still a negative number, but it was better than expected. The market was expecting minus 0.8 and it came in at minus 0.7. So a better figure than what the market was expecting. Thus, we would have expected some US dollar strength off the back of that. So as we can see here, the rationale for the trade, this is your trading plan or your trading idea. Why did we buy dollar CAD? Well, the Canadian dollar was suffering from some short-term weakness because of the worse than expected GDP figure. Whilst the US GDP data came in better than expected, therefore we expected to see some short-term strength in the US dollar. So our whole thought process around buying dollar CAD was to benefit from the stronger dollar and the weaker Canadian dollar. Now, as it says there, it also aligned with this short-term data, aligned with our bigger picture, i.e. the Canadian Central Bank being bearish on their currency and cutting rates, whilst the American Central Bank was heading towards a rate hike. So the short-term data was in conjunction to the bigger picture as well. So the most obvious trade was a buy trade on dollar CAD after those data points were released, taking full advantage of the strong dollar versus the weaker Canadian dollar. It was a classic pairing of strong versus weak data in support of the bigger picture. So let's have a look at what happened at the point of that data release. So as we can see here, the dollar CAD chart that we're seeing here on the 5-minute chart headed significantly higher from the 1:30 news announcement. And remember, my charts are 2 hours ahead of London, so this was actually the London 1:30 news. So as illustrated by that blue box there. Now the pair rose over 90 pips over the course of the next few minutes, showing significant strength in the US dollar and significant weakness in the Canadian dollar for maximum one directional impact. Okay, so example 2. An Aussie Kiwi buy trade after the Australian employment data, and this took place on June the 11th, 2015. Why were we trading this particular currency pair? Why were we buying it? So let's go through the rationale again. So here we see that on Thursday, June the 11th, at 2:30 in the morning. So if you're in the Asian session, trading in the Asian session, you'd have been able to take advantage of this trading opportunity, whilst the previous example took place in the North American session. So the rationale for the trade: the Aussie employment data came in much better than expected. So again, let's have a look at that. So expected to the employment change 12.1 thousand, when it was actually 42,000 people added to the payroll. So that was a very, very good figure. Now, in regards to the unemployment rate, a better figure would be a lower figure, because we want the unemployment rate to be low. So the market was expecting 6.2, and got 6.0. So those two figures put together, which is employment data, high impact, were very, very good for the Aussie. Now, why did we trade the Aussie against the Kiwi specifically? Well, if the Aussie was going to benefit from some short-term strength, we needed to make sure that we put it against a currency which was weaker than the Aussie. So if you notice, if we go back the previous day on Wednesday, June the 10th, notice that that was the day that the New Zealand Central Bank cut their interest rates, so from 3.5 to 3.25. So the Kiwi was struggling massively off the back of that. So the Kiwi dollar weakened significantly off the back of that reduction in New Zealand's interest rate. So we had complete divergence. We had really bad data out of New Zealand for the Kiwi, meaning that the Kiwi was very, very weak, whilst the Aussie data was very, very good, meaning that we got some short-term Aussie strength. So what would we look to do? Well, the currency pair that we'd look to trade would have been Aussie-Kiwi once we got the good data from Australia. If that Australian data had come in worse than expected, then we wouldn't have traded it because we'd have had week against week. We only traded this opportunity because we had strong Aussie dollar against the weak Kiwi dollar. And again, it was a classic pairing of strong versus weak data, which essentially links into a strong versus weak currency pair, which provides us with the greatest possible moves. So let's have a look at the chart at the time. So the candle is the 5-minute candle that's been highlighted by that blue box. And as we can see, the Aussie-Kiwi currency pair headed significantly higher from the 2:30 news. Again, London time. The pair rose over 100 pips over the course of the next few hours. Again, very, very one-directional movement. We want to get into that trade as soon as the news is released so we can maximize our gains from that trade. Okay, example 3, a Kiwi dollar sell trade after the New Zealand business confidence figures. This was on the June the 30th, 2015. So as we can see here from our Forex Factory calendar, at 2 a.m. on Tuesday, June the 30th, we had some business confidence figures out of New Zealand. Now, in this case here, we didn't actually have an expected. So where you don't have an expected figure, we can just use the previous, which essentially becomes our expected figure. So previously it was 15.7, so good confidence in the business sector, which is obviously good for the Kiwi dollar. But it dropped off significantly this month to minus 2.3. So business confidence was suffering, which is obviously going to have a detrimental impact on the economic picture in New Zealand, which will have a knock-on effect to weaken the New Zealand dollar. So that figure came in much, much worse than previous, stroke expected. So it was an opportunity to sell the Kiwi against a strong currency pair. Now, why did we pick the US dollar? Well, at the time, the US dollar from a longer term perspective was much stronger than the Kiwi. Why? Well, Kiwi had recently cut interest rates, bad for the local currency, whilst America was starting to head ever closer towards a rate hike, which is good for the local currency. So what we did is we paired the weak Kiwi against the stronger currency, which was the US dollar at the time. The most obvious trade was a sell trade, because remember, the Kiwi is the base, the weaker currency, and the US dollar is the terms, the stronger currency, so we'd expect that pair to fall. So the most obvious trade was a sell trade on Kiwi dollar, taking full advantage of the weak Kiwi, which we received from this data point, against a stronger US dollar, which was the bigger picture, suggesting that America is heading towards a rate hike. And in terms of looking at the chart, as we can see here, this is the box highlighting the candle where the news took place. It's the hourly chart here. Again, don't worry about time frame, that's irrelevant. All we need to do is get in as soon as we get a trade plan or a trade idea that comes together and the news confirms and backs that up. So this was the news release at 2 a.m. in the morning, London time. And as we can see, the market dropped off a cliff. So Kiwi dollar, the exchange rate of Kiwi dollar fell significantly from the news event, and it fell over 160 pips over the course of the next few hours. Again, we're not looking to take every single pip from the move, we're just looking to take a proportion of it. However, when you get your trade plan right, when it comes together, you get some significant moves, and we're looking to take a small proportion of that and then look for our next opportunity. Okay, example 4. An Aussie dollar sell trade after the Australian retail sales figures on July the 3rd, 2015. Again, same process. I'm repeating it, so it becomes second nature for you. Okay, so Friday, July the 3rd at 2:30 a.m. Aussie dollar retail sales came out at 0.3, which was worse than the expected figure of 0.5. So bad data from Australia. Consumers were not spending as much as the market expected. Obviously, that's detrimental to the Australian economy and detrimental to the local currency. So, the rationale for the trade. The Aussie retail sales came in much lower than expected. This weak short-term data was in combination with the longer-term picture, with the Central Bank of Australia having recently cut interest rates. So not only was this short-term data bad, it was in sync with the bigger picture, i.e. the Central Bank of Australia, the RBA, having recently cut rates and having a very bearish outlook on their economy. So ultra weak Aussie dollar right now. And we therefore expected the Aussie dollar to weaken significantly after that bad data point. So what we did is we paired that weak Australian dollar against a stronger currency pair, which at the time was again the US dollar, because the bigger, longer term perspective was that the US Central Bank was having a bullish stance and heading towards a rate hike, which is positive for the dollar. So most certainly the Australian dollar was weaker than the US dollar. So we put the two together. We got our currency pair, which was Aussie dollar, enabling us to take full advantage of the weak Aussie versus a stronger US dollar. So again, let's have a look at the chart. As you can see, as highlighted by this blue box, this was the point of the announcement, and as we can see, the Aussie dollar pair sold off significantly from the 2:30 news. The pair fell over 100 pips over the course of the next few hours, comfortably generating a nice profit on this particular trade. And then finally, example 5, just again to reinforce the same process. We find the news announcements, we find a strong and weak currency, we put the two together, and then we either buy or sell it depending on what the base and what the terms is. So example 5, pound dollar sell trade after UK manufacturing data on July the 7th, 2015. So this took place in the European session, or the London session. So as we've seen with all the examples, there have been trading opportunities that have set up in the North American session, in the European and London session, and the Asian session. So it doesn't matter what time zone you are in, there will be opportunities on a regular basis for you to take advantage of. And if you don't sleep, then you can take advantage of all three time zones. Okay, so 9:30 a.m. on July the 7th, we had manufacturing production from the UK. It came in much lower than expected. As we can see here, a shocking figure, minus 0.6 versus an expected 0.1. So the market was expecting a positive figure, and it got a shockingly bad minus figure. We therefore expected the pound to weaken off the back of that bad data. However, it's important that we paired the pound against a currency which was stronger than it, which at the time, the only currency that was stronger than the pound was the US dollar, because they were getting closer to raising rates than in the UK. So the dollar was more bullish or stronger than the pound at the time. So we had short-term weakness to give us a great pairing of the weak pound versus the strong dollar to take full advantage of a trade selling pound dollar. So as you can see here, here's the pound dollar on the 5-minute chart. I can show you this is where the news was released, 9:30 a.m. European London time. And as we can see from that point, the pair sold off significantly and fell over 100 pips over the course of the next few hours. So that essentially has just met your plan and given you the desired outcome. But what I wanted the case studies to do was not to really bang on about how many pips you can make, this, that, and the other. It's more to reinforce how your process and your routine and your structure and your trading plan and trading idea need to come together first before you take a trade. Always have a reason as to why you are selling a particular currency pair or buying a particular currency pair. Within that currency pair, always make sure that one of the currencies is strong and one of the currencies is weak, based on the bigger picture and the short-term news announcements that take place. But the process you follow is going to be identical every single time. The only thing that's going to vary is obviously the currency pairs you're trading, the day you're trading them on, and the news you're trading. But your process in terms of going through that routine and building your trade plan is going to remain the same. So hopefully this video has just reinforced all of the learnings and brought everything together and cemented a lot of things in your mind. What I will do on an ongoing basis is continue to update the course with more recent examples, because obviously these are recent examples now, but in 3 months time we'll have a fresh crop of examples to go through. So I will update the course with those examples. Also, if you're following and subscribing to my website, I'll be updating via some videos there as well. So I'm going to wrap up there and we'll head on to the next section.